Well, I wish I did this video when standing because I really wanted to stand out. I'm the Blue Ball Forex. Of course, this is the Insight Empire and this is the home of Forex Trading Insight. And today we will be talking about 5 things that you need. 5 things that you need in my own approach to trading. 5 things that I do and 5 things that I worked on and which have really helped me to scale up as a forex trader real quick. So once again, this video is an educational video and information conveyed through this particular channel is for educational purposes. Remember, trading in the financial market is risky and past performance does not always guarantee future results. Actually, it is very critical for you to acknowledge that risk. It's very important because it is part of business. Just like any other business, losses and profits are part of the trading or a part of any kind of a business. Now, let's start with the first C because we are now talking about the 5 C's that you need. 5 C's that you need to succeed as a forex trader. Now, the first one is called capital. Now, capital is very important. Forex trading is not a job, it is a business. Forex trading is not a job where you get paid salary for delivering services. It is a business that you get a profit by leveraging on the discrepancy between where the price is bought and where the price is sold, or where the price is sold and where the price is bought. So this is basically a business, and so capital is very, very important when you are trading. Now, what is a trading capital? A trading capital is the capital that you have set aside and deposited it already in your trading broker for you to be able to execute live trades in a live engagement. Now, when we say capital, we have real capital and paper capital. Now, paper capital is basically a demo account or a paper money account. Now, this capital is not supposed to help you. It is used to backtest and used for strategies. And I'm here to tell you that particular capital is the reason why 98% of most retail traders who start within maybe 5-6 months quit forex trading, because that demo is the only biggest scam I know in forex trading. Now, let me break it down. Demo account gives you false confidence that you do not have in the actual market chart. Think about it in this way. Most people who start learning forex, they end up depositing capital, let's say of $500 or even $1,000, some even as low as $250 to begin trading with. So if you come with a demo account, let's say of $20,000 or $50,000, and you practice with this demo of $50,000, trading environment is different when you are managing $50,000 account and when you are managing $2,000 account. It is not the same. So when you have a demo of $50,000, you practice with a demo of $50,000, and then on the actual day of the trading, you deposit $100 to trade with. You are likely to lose your $100 very quick, and you wonder, why did you lose $100 and you have been making money in demo? It is like doing a practice using a racing car. Let's say you are doing practice for racing competition, and then you do practice with those high-end racing vehicles. I don't know, they're called GT or what. Those heavy, sleek cars for competition. But then you do the practice using those specific cars, and then the actual day of the competition, you pull out with a Nissan Note Nismo 2019 model for the competition, or even a Toyota Vitz for the same competition, which 0 to 100 will of course take between 8 to 15 minutes. So you are likely to lose that specific competition because you trained so well, but during the actual time of trading or engagement, you pulled out with a facility which could not enable you to win. Okay, so that is why it is very important. Even if you are trading with a demo account, try to minimize the demo to an actual realistic funds that you can afford to deposit, because you don't want to learn the way of false confidence and then you come to the reality, it is hitting extremely different. Now, that is it about the capital. Now, the second thing which matters a lot is about the calculation of the capital. Now, I have my capital of $1,000, $20,000. Capital calculation is very, very critical. Now, how do you do capital calculation. Now let me break this down to you. There is one big lie again that I don't want you to adopt, called risking 1 to 2% of your account. Let's just be honest. Most retail traders, their 1 to 2% is almost nothing, because if someone is trading, let's say with $500 and you tell them to make 1%, what is 1% of $500? If you do like a math of 1% of $500 is literally $5. And just imagine sitting down as an adult for 3 hours just to get out of the office with some $5 in your pockets. That maybe will instill some sense of insecurity to your dependents. So it is very critical that you know that that thing only works for people with big accounts. Let's say of $200,000, so that even if they make 1% of, let's say, the $200,000, they are making like $2,000, which might be something that is supposed to make sense. But now for you, if you have $10,000, you have $1,000, $500, someone telling you to risk 1% looking for 2%, that is person who wants to waste your time. Okay, he just wants you to lose your money in bits until you blow fully. Now this is how I do it as Blue Bull. I diversify my capital into 10 trades. I can never accept to blow an account or lose any money until I take 10 trades from that account. I take 10 trades. I risk 10% of my account looking for 30 or 40%, because I have a very big high risk to reward ratio. So if I have 1,000 USD, for example, which of course I don't trade such accounts, if I have 1,000 USD and I am trading with that 1,000 account, I would prefer to risk $100, targeting $200 or $300. For by the time I blow this account, it's either I have taken 10 trades with that account, and it is practically impossible to lose 10 times consecutively unless you are working very hard to make sure that you are not following any rules and you are very much incompetent and your strategy is very, very weird. It is very, very hard for you to do 10 trades, losing trades like consecutively, a loss after loss for 10 times. It means maybe your psychology is not aligned, your strategy is way, and probably you are not very competent in what you do. So so long as you are a trader, I don't think it's practically possible to enter into a losing trade 10 times. So what I do is I risk 10% of my account and I look for 30 or 40%. So if I have begun with 1,000 USD and the first two trades are good, I'm able to make, let's say, 800 USD, because if I get like 300, 2 times that's 600, that's almost like 60% off of my account. This thing of being told that 7%, target 4% per week, and then it's 4% of $2,000, it is waste of time. And this is just to be realistic with you. It is very, very difficult for you to make money using that specific approach. So do your calculation based on yours. I've told you based on what I can afford to risk. I can afford to risk 10% of my account looking for 20 or 30%, because we are not hedge funds. So you're not looking for 1% of 250 billion. You're looking for 1% of $100, which is critically a waste of time. So it's very important for you to do your calculation based on that. Now the third one is called consistency. Now this is where consistency comes in. Now when you, for example, in my consistency part, if I'm risking 10% of my account, I have to make sure that is exactly what I'm doing. So I cannot even lose $101 from a $1,000 account. Why? Because I want this this account to take 10 trades. So if I hit like $100 mark in drawdown, I am out consistently. If my setup has failed and I am negative 100, I'm out. Why? Because I want to take 10 trades in this specific account. So based on my calculation, I'm consistent. Now the other one is control. I'm always in control of my account because I know the outcomes are true and I've made peace with the outcome. It's either I'm gonna lock my day with 40% or 30% or a negative 10%. So that is what basically informs my trading approach, because I feel I'm in control of the price. I feel I am fully in control of the price. Why? Because I am applying risk management based on my approach. That is one. And secondly, I do not allow emotions to get in, because I already know the outcome of the price and I have already accepted the possibilities of losing either 10% or getting 20, 30% or even 40%. Now that is it. Now the other one is called contingency planning. This is very key. Contingency planning. Now, contingency planning is where you plan for outcomes which might basically you are not in control of, but they are have a probability of happening. Okay, for example, if I have $5,000, I won't be intelligent enough to put it in one trading account and decide to be trading that specific account. No, but I would choose to diversify my portfolio in this way. I can decide to have 2,000 in one account, 1,000 in a different account, and then 2,000 in another account. Then the small account, I make it for high risk trade only. For example, during the time when we have fundamental news and you want to participate, because those are the times when maybe you can make like maybe 4 or 5 times your account size if the market goes your direction. So it's something that I'm willing to lose $100, $200. Practically, you can't die for losing $500. So if I have, let's say $3,000, I will put some 500 and say, now this one is for high risk trade. Okay. Now then this one, I'm gonna be taking the trades. Now this is my main account, let's say of 2,000, and then this 2,000 other 1,000 is my backup plan just in case I happen to lose my first deposit. So that is very critical for you to learn how to diversify your portfolio. And also in contingency planning, you are planning for in case of these outcomes. What do I do? In case the market turns my direction, how do I exit manually? Do I wait for the account to blow, or do I even have a stop loss, which is very important? So that is basically what we call contingency planning. I'm the Blue Ball Forex, and I'm here once again next time to teach you on another part 2 of this particular conversation. This is Forex conversation, leading you into becoming profitable trader through doing proper analysis, 1, and then applying these 5 C's, which are very critical in your trading career. I'm the Blue Ball Forex, and see you in the next one.